Before we begin, please note this video is for general educational information only and does not provide personalized mortgage or financial advice. Mortgage suitability depends on your individual circumstances and lender criteria, so professional advice should always be taken before making any decisions. A further advance is when you borrow extra money from your current mortgage lender, adding it to your existing mortgage loan. Think of it as a top-up on your home loan, secured against your property. Homeowners often use it for significant one-off expenses: kitchen extension, loft conversion, landscaping the garden. Others might use it to consolidate more expensive debts into a single, lower-rate loan. University fees, wedding. The main appeal is simplicity. It can also be more cost-effective than other options. Because you're dealing with your existing lender, the process can be quicker and often involves less paperwork than a full remortgage to a new provider. You are a known customer to them. They already hold the primary legal charge over your property. That familiarity can streamline the application. Arrangement fees can be lower than remortgaging, and you may avoid early repayment charges if you stay with your lender. Lenders must also explain alternatives, such as second charge loans. Maximum borrowing usually sits around 80–90% loan-to-value, or LTV. Many lenders cap further advances at around 85%, sometimes up to 90%. There's often a 6-month ownership or mortgage rule before they'll consider your application. Loan term usually matches the remaining mortgage term, though shorter terms are sometimes available. Remember, lenders are not obliged to lend. Decisions are affordability driven. They'll look at your income, your regular outgoings, your credit history, and the equity in your home. They must be confident you can manage higher monthly mortgage payments, and they'll consider the purpose. Value-adding improvements are viewed more favorably than discretionary spending. Borrowing for a luxury holiday or a new car is less likely to help their security. All of this sits under strict Financial Conduct Authority rules. Even if you meet the basics, lenders can still say no depending on risk appetite and your circumstances. Employment changes, credit dips, or wider economic uncertainty can all affect outcomes. A crucial part of any further advance application is the affordability assessment. It's a deep dive, very similar to the checks you went through for your original mortgage. Lenders are legally required to ensure you can afford the higher payments. Expect to provide recent payslips, P60s, or, if self-employed, several years of accounts or tax returns. They'll scrutinize outgoings, credit commitments, household bills, childcare, regular spending, and entertainment. The rate on the advance might differ from your main mortgage. Your original loan could be on a low fixed rate while the new borrowing may be on SVR or another product. This creates a blended mortgage with two parts. Ask for a clear illustration of the new rate and your total monthly payment. If other adults live in your home who aren't on the mortgage, a partner, an adult child, or a lodger. Occupants age 17+ will almost certainly need to sign a consent to mortgage form. By signing, they acknowledge the mortgage and agree to give up any right to remain if the lender repossesses. Refusal to sign usually stops the application, so discuss it openly before you apply. If you're borrowing for home improvements, valuation is central because LTV relies on current worth. Lenders might use a desktop valuation, faster and cheaper. For larger loans or complex projects, they'll likely insist on a physical valuation by a chartered surveyor. Some lenders lend against anticipated future value, known as post-works valuation lending. They assess plans and agree an amount based on expected value after completion. You'll need substantial evidence, detailed drawings, a fixed-price builder contract, and all necessary permissions. If planning permission is required, it must be fully approved before funds are released. Works must comply with building regulations, covering structure, fire protection, and energy efficiency. Lack of consent can halt borrowing and even devalue your home. For major structural work, lenders may ask for an architect's certificate. New builds or conversions often need a 10-year structural warranty, e.g., NHBC. Have all paperwork in order before you apply for a smooth, successful process. When you take out a mortgage, the lender places a charge on your property at HM Land Registry. Your main mortgage is almost always a first charge. If the property is repossessed and sold, that lender is first to be repaid. A further advance from the same lender is usually tacked onto the existing first charge, meaning it keeps the same priority, which lenders like because security isn't compromised. It's more complex if you already have other secured loans. For example, a second charge from another lender. A second charge sits behind the first. New money would normally slot behind that second charge. To avoid this, your first charge lender may insist on a deed of postponement, where the second charge agrees to postpone its priority. This lets the further advance take priority. Getting that agreement can be complex and may involve legal fees. Tacking is the legal mechanism allowing further borrowing to be added while keeping priority, subject to UK law and your deeds clauses. Most residential deeds include further advance clauses that specify priority, simplifying the process. But other charges can complicate things. Legal advice helps you understand sale priorities. A further advance increases your total debt and monthly commitments. It reduces your equity, the part you own outright. Lower equity can make it harder to remortgage to competitive deals later. Best rates are often at lower LTVs. Affordability checks protect you and the lender, ensuring you can cope now and if rates rise. While a further advance can be straightforward, it isn't the only option, and it may not be best for you. A second charge mortgage sits behind your main mortgage, useful if your main deal is a low fixed rate or if your lender declined. You could remortgage to a new lender for a higher amount. Watch early repayment charges, arrangement, and legal fees. For staged works, a drawdown mortgage lets you take funds as needed, so you only pay interest when you use them. Independent professional advice matters. A qualified mortgage advisor can compare further advances, remortgages, and second charge loans, explaining costs, benefits, and risks. A further advance can be a powerful tool when used correctly, but understanding the rules is essential. Always take professional advice before making any mortgage decision.